in Montana. And so we know that with a graying state, an aging state, with a strong entrepreneurial spirit that we have, and lots of business leaders that own or are leading those sort of businesses, that it takes time to transition properly out of a business. And that's not something that you can make a decision of today and go through that sort of a process. And so our intent here is to convene the leading experts in the various fields that are necessary for transition planning. We're not trying to sell you anything. We're just trying to provide some information. And just as importantly, as our intent is not necessarily to answer every question that you might have with regard to transition planning, but just to begin that discussion and to plant those seeds for your consideration so that you might talk with your own professional advisors on the various aspects of transition planning, or reach out to any of one of the panel experts that we have convened here today to follow up and to begin some of those sort of discussions. We are recording the session. We're going to keep this anonymous, and we're going to keep it confidential. If you have questions, feel free to hover your cursor on the lower half of the lower quadrant of your screen there, and you see a little chat feature down there, and you can type a chat in there. That question will be confidential. I'll pick those questions up and then direct that question and those questions to the appropriate expert that we have on the panel here. So thank you again for your interest in this. We hope that this will provide you with some basic foundational thinking points that you can start as you consider whether or not this is the time of your life that you should start thinking about transitioning into the next phase of where you want to go. So with that, I think we'll start with our panel here so we can conclude on time here. We'll start with Vu Pham, and Vu has got a fascinating background. Vu left Vietnam, where he was born, and he left Vietnam in 1975 as a refugee. He grew up in the Midwest. He made Montana his home over 20 years ago when he first came to Missoula to attend the University of Montana School of Law. He spent 12 years working as the staff attorney to U.S. District Court Judges Richard Siebel and Jack Shandstrom. He then went back to school and got a master's degree in health administration. He became the general counsel of a large industrial conglomerate in the trucking, mining, oil field service, landfill, and construction space. And he later then became their CEO for 6 years. Based upon his breadth of experience, he has experienced and understands the entire spectrum of business, from running and scaling to strategically growing sustainable businesses. This broad understanding enables him to advocate on behalf of his clients as they navigate the complexities of business and law. Vu, the floor is yours.
Thank you, Todd. I am blushing. You're very kind. And I'd like to thank all the attendees for taking the time and engaging in this topic, which I think is a very important topic. I mean, as business owners, the fact that you're here says that you're on the business rather than in the business, and that you're thinking ahead on what's next, what's around the corner for you. And so I'll try to kind of get into what the topic is transition planning. I call it exit planning. Conceptually, it's the same thing. And what are you selling as business owners as you think about exiting? And the crux of it is you're looking to create value and transfer that value. And the reality is it is an inevitability that you will leave your business. I mean, it will be through death, divorce, dissolution, disability, or divestment. And as business owners, you have responsibilities to your customers, responsibilities to your employees, responsibilities to your family, to ensure that that transition is as smooth as possible. There's a definition for exit planning, and I'd like to read it to you right now. An exit plan asks and answers all the business, personal, financial, legal, and tax questions involved in transitioning a privately owned business, which 80% of most small businesses are. Includes contingencies for illness, burnout, divorce, and death. Its purpose is to maximize the value of the business at the time of exit, minimize taxes, and ensure that the owner is able to accomplish all his or her personal and financial goals in the process. I mean, the underlying concept is about value, transferable value, and how do you do that? Transition planning, exit planning is, in all honesty, it's good business strategy. We have to, as business owners, we need to think about it. And it can't be done by any single person. It's a collaborative approach. And with you, the business owner, as the hub of all of that. And we've been blessed to get all these other panelists on here that bring, we all represent a spoke of that entire hub where you as a business owner are the center of it. So can we go to the next slide, please? So the way, what I do is I'm more of an operational risk manager role. That's the spoke that I bring to the whole exit planning, succession planning process, where I come in before you're ready to sell. And we look at ways on bringing value and maturing value in your business. So I'll come in usually about, depending on where you're at within your business model right now, I'll come in about maybe 2 years to 3 years before you're ready to sell. And we'll look at ways to identify what you have, where you're at. We identify where you want to get to, and we identify how much time do you think you want to spend or need to spend in order to get from here to there. And that's the crux of the work that I tend to do with my clients right now. So we identify where you're at financially, legally, tax, and time frame, and we look at your succession team. What's the strength of your employees? We talk about who do you want to sell to, because that's really important, because what we're building toward your ultimate buyer, whether it's a strategic buyer, or if it's your employees, or if it's your family that is going to take over that business. So we need to design and build the business toward that ultimate exit goal. So that's really key, because we don't want to flounder and waste time and effort, because it's not light lifting to do this type of work. So identify where you're at now, who you want to sell to, how much time do you have, and then we start looking at what are the components to de-risk your business in order to ensure a successful exit. And then we build toward that. We do the work, the heavy lifting, whether it's looking at your customer base, the concentrations of your customer base, looking at market sectors, the concentration of your market sectors, and then we build to manage and reduce and de-risk your business as much as possible. And then ultimately, it's about harvest. I mean, you've put sweat, toil, tears, you've financially invested time, time in the business, time away from your family, and now you're ready to harvest the hard work. And then we work with all these other great panelists in order to help you harvest. And then what's next? That's key. What's next? What's the next stage? I mean, what are you going to do afterwards? If you can't clearly answer that question, then maybe you're not ready to leave your business. So if we can move on to the next slide, please. So, you know, profit and loss statements tell you where you're at financially. It tells you, your balance sheet tells you what your assets worth, what the depreciation is going on. But the real value is in these 4 C's here. There's human capital, there's structural capital, there's customer capital, and social capital. And these are the true values where this is what you're really selling at the end of the day. This is the blue sky. I mean, what's the human capital look like? What does your team look like? What is your relationship to your employees, the strength of your customer base, from customer capital? How much work is your team ready to take over your business and manage it for you? Are you dispensable to your business? Because that's key. When we're talking about Value is in transferability. If it cannot be transferred, then the value is diminished in your business. So how do you develop your team in order to get them to stand in your shoes and run the business if you decide to leave? Structural capital. How have you built the systems of your organization, both from an operational standpoint and from a financial standpoint? Do you have systems in place for scale, for growth, for divestment? And do you have processes in places to take risk? How do you analyze risk? And then there's customer capital. What is your reputation in the larger community, amongst your peers? What is your relationship to your customers? Do you have contracts in place? Do you have a strong network of diversified customer bases where if something happens to one customer, you're still covered on another with all your other customers? You know, if you, by example, if you have a customer that represents 30% of your entire revenue stream, then that's something to talk about. And then also the social capital. How does your team play together? How are your partnerships with your vendors and your customers like? And how do you work through that and create collaborative partnerships? So this is what really the crux of what you're selling is. And how do we look at that? How do we pull the levers in order to make sure that that value is concrete, that it's transferable to the next potential buyer, whether it's strategic, whether it's employees, whether it's family, whether it's ESOP. So next slide, please. So this is kind of the model that I tend to use. I'm a certified exit planning advisor. I'm a member of the Exit Planning Institute, and then I'm also a member of the Business Enterprise Institute. And those two organizations are probably the more well-known, larger succession planning, exit planning organizations in the United States. And we're looking at ways to help business owners like you transition. The reality is there's a silver tsunami that's occurring right now. The baby boomer generations is stepping aside for the next generation to come up. And there are a large number of businesses that will be coming on the market the next 10 years. The number that's been thrown out is $10 trillion worth of businesses will change hands in the next decade. And what does that mean? That means if you're looking to transition, especially outside, then you're going to be competing for dollars that James and Don are going to talk about. And so you have to look at how do you make your business as attractive as possible in order to get the true harvest of the work that you've put in. So we've got three pillars. We've got discover, prepare, decide, and then decision on keep or sell. So the discover is really about where are you at now? What is your business really worth now? What other assets do you have outside of your business? Because it's very likely that the vast majority of your net worth is tied into your business. So you need to know, what is that? What does that look like? Today, if you were going to sell it, what is the value of that? And then what other assets do you have outside of that? And once we understand that, we know where you're at. And then we think about where you need to go. Okay, I've got $1 million. Let's say my 5 million. My company is worth $5 million. I'm going to need about 10 million ultimately. So, and I've got 5 years to get there. So how do we get from 5 to 10? If that's what you need as you work with your wealth manager, as you work with your accountant, and understand where do you need to get to. And then we look at internally in your business. All right, this is the gap. How do we close the gap? And we started working on strategies to close that gap. And first, we start by de-risking. We look at all the areas of risk in your business. We work through that, whether it's legal, whether it's financial, whether it's operational. And we clean that up, we work through that. And then, interesting, when we work through that and we focus on those things, not surprisingly and very often, we become more profitable at the same time. And then once we get to where we want, we're at 10 million. We've done the heavy lifting. We've added value that's transferable for our business. We come to a decision point. Now what? And the decision is, do we keep or do we sell? And that's the goal, is how do you create a business that is ready to be sold tomorrow, yet can be kept forever? And that's the decision point and the ultimate goal that I work on with my clients to get to. So let's go to the last slide, please. So this is kind of a little summary of that was done by the Business Enterprise Institute on what business owners were looking at and what they were thinking about transferring timeline. And I thought I'd throw this out there just to give you a broader lens of what it looks like. 56% of business owners want to sell or transfer their ownership in the next 10 years. 81% want to stop working in the next 10 years. 100% will leave one way or another. And then it also breaks out when their exit plan is and what that looks like. There is this is happening, and business will be sold and transacted, and the market will change. Where right now, I'm sure James is going to get into a little bit, where there is more money looking to buy businesses than there are good businesses to sell right now. And over time, in the next 5 to 10 years, it's very likely that paradigm is going to flip. And how are you as business owners going to be competitive in the larger marketplace? And that's all about de-risking and cleaning up, creating transferable value. And if I can get anything across, that's the key point that I'd like to present. So with that, I'll end my time here. Thank you, Todd.
Thanks, Phil. Great overview. We'll turn to James Thompson. And one of the things that I think is important to point out here is that this team of experts in their respective field that we've assembled here all have extremely strong ties to the state of Montana. They're either living in Montana or they spend a significant portion of their time in Montana, all with kind of the same sort of ultimate desire, is to be able to see succession planning take place and to keep those sort of jobs and businesses alive and thriving in Montana for the health of the Montana economy overall and for the success of the individual entrepreneurs. So we're going to turn next to James Thompson, and he's a good example. He grew up in Butte, America, USA, spends about half of his time at this place that he has in the Big Hole Valley, working as an advocate on behalf of Montana entrepreneurs on raising capital and transitioning their businesses. Half of James's professional life has been spent in the corporate finance world, banking, investment banking, and venture capital, and the other half running companies as the CEO, or at least as a functional leader on the leadership team. Throughout his career, James has closed over 40 transactions and has raised over $250 million in growth capital. James is a member of the board of directors of Brown Strauss Incorporated. He's also on the board of directors for the Montana Ambassadors, a strong advocate for the state of Montana. Serves at the pleasure of the governor on that board, and he's a volunteer, nonprofit, nonpartisan organization of leaders in business, which is that Montana Ambassadors. Having been on all sides of the table, both as an operator, financier, and intermediary, James brings a unique perspective to advocacy work. James received his BBA from Gonzaga and his MBA in entrepreneurship from the Foster School of Business at the University of Washington. James, you got to unmute yourself. You're still on mute, James. There you go.
All right. Todd, thank you. My mother could not have said it any better. I appreciate that. Thank you, first of all, to the Chamber for putting this together, for the sponsors of the Chamber, to my fellow panelists, folks I've gotten to know and trust over the last couple of years working here in Montana. Alexander Hutton, we are investment bankers, and we help entrepreneurs find appropriate buyers for private companies, really optimizing price and deal terms and cultural fit. There is a complicated, often complicated process. And I can't underscore what Vu just shared. There are 7 million private companies in the US with owners over 55, and 15,000 right here in the state of Montana. And at the same time, there's been about $1.5 trillion of capital raised by private equity firms. There's a further sort of $10 trillion of high net worth family offices that are looking to buy private companies. And Montana is a state of entrepreneurs, and there is a lot of activity in and around outside and inside capital. You'll hear from Don McGee from Good Works about the work that she's doing is a great example of putting capital to work in Montana companies. Alexander Hutton is a firm that my partners and I work with entrepreneurs. It's the oldest firm in Seattle. We've done deals all over the Pacific Northwest, 214 transactions, 30 plus years. We have international partnerships. We work on cross-border deals through our Oakland's relationship. The unique aspect of the work we do, and I think it gives us a unique perspective, is that we're all former CEOs. I think having been a CEO or a leader of a business, I think it gives you a unique perspective to advise other leaders of businesses. And we have sector expertise. If you can move to the next slide. We have sector expertise in a variety of areas through our Oakland's relationships. Kimberly, could you move to the next slide, please? So just a quick comment of the work that we do, and we're working with several Montana companies today. We are working with companies that are looking to either, as an example, an entrepreneur might want to take a few chips off the table and sell part of his or her company to indemnify the family, as we say. They can sell 30% of their business, bring in an outside capital source to come alongside and help not only put a few chips in their pocket, but also to fuel their growth ambitions. And we have a number of clients like that here in the state. What's unique about the work we do, and I'm lucky enough to spend half my time here in the state that I love, is that a lot of investors, and these are institutional capital that comes from ultimately endowments, universities, high net worth individuals that are in these private equity funds, a little bit like buying a mutual fund, if you will, that then invests in public equities. What makes Montana unique is that when you're off the beaten path, and we spend a lot of time in places like Eastern Washington and Idaho and Montana, what's unique is that the businesses kind of can dominate their market in whatever they do. It may be a small market with 1 million people, with your main street being I-90, but when you dominate a market, you can charge more for what you do in some instances. And we've represented clients that have above average gross margins because they're in a smaller market, and outside capital loves above average gross margins. So it's been unique to see that happen. We also have just terrific people in this state. I may be biased, but the business leaders that I have met over the last few years in this state are extraordinary. Hardworking. It's a state of entrepreneurs, and hardworking and humble, and are very easy to put in front of outside capital. Oftentimes you're representing a client and you're worried about how are they going to hit it off, and will they present well, et cetera. And I have been very impressed with the quality of the entrepreneurs in Montana. With regard to Oakland's, we do more transactions than other firms. And with every additional transaction and doing this over decades. We just get better at what we do. Can we move on to the next slide? So just wanted to share a couple of examples, and I would encourage all the panelists to use examples to kind of put a little bit more context to what we're talking about. This is a complicated, successful business transition is a complicated area, and you'll hear from experts in law and accounting and wealth management. It's complicated. These examples, this is a company that we just sold. We represented Bill and Connie Buckingham. This is a Seattle-based company. Started out, Bill was the plumber and his wife was the bookkeeper, and built a business over decades. Now have 60 plumbers running around Seattle and had the #2 brand. They decided they wanted to retire. So that was an entire sale. They wanted to buy a boat and be up in the San Juans and enjoy the fruits of their labors. But what was really important in that transaction was that we keep it quiet. So this is especially true in small markets. You know, keeping things confidential is critical. And so they said, look, you know, there are 3 folks we'd like to go to. We obviously want the best deal in terms of price and structure and cultural fit. We want our people to be taken care of. And I hear that over and over again from successful entrepreneurs. And we were able to do a short process. We were supposed to close March, right in the middle of COVID. But the business performed right through the COVID period. We got it closed finally in June. There were 15, it was a private equity fund that bought the business. They had a holding in the plumbing business, and they like to add on to those holdings because in our world, price has a premium. So smaller things are worth less than bigger things. And if you put them together, the multiples on EBITDA or profit go up. So there's a consolidation that happens in these industries, and these guys consolidated the plumbing services business. And obviously in COVID, everybody was home, and the numbers that would come out month over month actually continued to improve and beat budget. So that was a successful transaction. We advised them all the way along the process. We're still giving them advice about what they do with regard to wealth management, et cetera. They look to us for all of the years of experience that we've been doing this. The second transaction was an IT services business. You can see there, they wanted to go broad. They wanted to find the best possible deal. We obviously keep it very confidential. We manage it carefully, but we're able to do this all under NDAs. We're only sharing information that is appropriate to the potential buyer. And you can see that from 100 parties contacted all the way down to an agreement executed was sort of a 4 to 5 month process. And this process is a 6-month process once you're ready. If you take Vu's advice, he would say you need 3 to 5 years to get ready. And so these are just 2 examples. One was both were entire sales, but as we're seeing now, we're seeing more folks just say, you know, I'd like to do a transaction like this, but I'd only like to sell 30% of the business and then sell all of it 5 or 10 years down the road as I look to retire. If we go to the next slide. So just a few market insights. You know, COVID obviously has had an impact on a lot of businesses. There are winners and losers in COVID, and it's been a very difficult period for people running businesses. There's no doubt about it. And some sectors have been fine, some sectors have been impacted, and some sectors will be impacted for many years. But what I would say in our world, there's a lot of appetite to do transactions. So this $1.5 trillion I mentioned earlier is under a lot of pressure to be put to work. And so as an example, I'm working on a transaction right now that has 12 offers on the table. And you would think, gosh, right in the middle of COVID, I can't believe people are making investments. But investments are being made. Capital, we're having to do it a little differently, a lot more Zoom calls, I have to admit. But the valuation multiples remain high, 10.5 times to, sort of plus or minus is actually the transaction volumes have dropped. There's no doubt about it, but there's still folks looking to put money to work. And I think that, I think from that perspective, when you're ready to make the decision, this is not a decision you take lightly. All of your advisors need to weigh in, but we offer perspectives, and we offer perspectives for every 20 perspectives I offer. I usually get asked to be an advisor, a formal advisor in a transaction. So anyway, the last thing that I wanted to share, we're advocates for entrepreneurs. If somebody knocks on your door and wants to buy your company, you do understand that doesn't mean you get a market-based price in terms of deal terms or the cultural fit. There is a process, whether it's Alexander Hutton or somebody else. The investment bankers are there to advocate on your behalf to make sure that you get a fair transaction and a fair price for your life's work. So with that, I will hand it off back to Todd.
Thanks, James. And I think there was a interesting point there that James illustrated in his slide deck that, they're doing deals for businesses that run the wide range of business sectors. He used two examples, one being kind of a more traditional blue collar plumbing sort of a business, and then all the way to high tech. And so I think that it shows that there's a lot of interest in a wide range of business sectors in the state. And so thanks for giving us those two examples of some of the work that you've done, James. We're going to turn next to Whipfly, and Dana Springer is our resident expert with Whipfly. She's another Montana native. We're glad to have her in Montana. She grew up in Polson, Montana. Only Butte gets the distinguished title of the USA immediately after the town, but Dana grew up in Polson. She attended Montana State University, fellow Bobcat with us, so go Bobcats, and she now lives in Havre. Dana is a partner at Whipfly and has been with the firm for 13 years. Her career is focused in the agriculture industry, providing tax consulting and transition planning services to across Montana. Dana and her family live north of Havre on her husband's family farm. Dana, and you're still on mute, so if you'd unmute yourself, the floor is yours.
Thank you. So my first slide here says everything starts with a conversation, and I think that's why we are all here today. We just have to start talking about transition planning, whether it's talking about it between your business partners, your family members, or with your financial advisors, your lawyers. You can't start the process until you've started having conversations, and usually we've found that the first conversation doesn't start the process. It takes a few conversations because it's not always an easy thing to talk about. It's not an easy thing to start doing. So we encourage everyone to just start talking about it, and we're glad you're here today. A little bit about Whipfly on the next slide. So Whipfly has offices across the US, also in India. And we are an accounting firm, but we are also a lot more. Because of the size of our firm, we are able to, one, focus in industries. And as Todd mentioned, I'm mostly focused in the agricultural industry, but we also provide a lot of additional services besides your normal tax preparation and tax planning. We have people who focus in research and development credits and valuations and cost segregation studies. We also have an IT team who develops apps, which is probably something that most people wouldn't expect an accounting firm to have. And then there's our consulting branch, and part of that is the transition planning. We have a process that we've developed by our team who focuses in transition planning to help people walk through the process and come up with a plan that's unique to their operation. We help lots of clients with transition planning, and every plan is unique because every business is unique. The owner's needs are different, depending on the industry, all of those types of things. I specifically joined the transition team because I see the need for transition planning every day in my home life on the farm. My husband works with his family, and transition planning is something that has been needed for a while in the agriculture industry, and it's just near and dear to my heart because I want to see the farms and ranches of Montana survive, as well as all of the small businesses. So next slide, please. So one of the things that we look at is, from the financial aspects of it, is looking at the personal issues versus the business issues. And in small businesses, these can be pretty intertwined. A lot of people have their businesses paying for things for them that if they're no longer involved in the business, they're going to have to pay for themselves. And so one of the things that we find extremely important is for the business owners to look at their personal financials and actually find out how much it would take for them to live after they transition away from the business. That's something that a lot of people don't think about until they're ready to be done. And the sooner, as Vu said, he likes 2 to 3 years to start planning. And I think that that's definitely true. The more time you give yourself to plan for these things and start looking at these things, the more successful you're going to be in your transition and the more options that you're going to have. That being said, there's a lot of people who wait until they're ready to transition out, and we can help them make a plan too. On the business side, looking at the business financials, looking at the financial preparedness of the company. So what are the cash flows like right now? Is there money there to finance a transition plan, or do you need the capital from the business now to retire? And then looking at your financial statements. It's really important to have good, clean financial statements, whether you're planning on transitioning your business to a family member or an employee, or to try to sell it to an outside investor. Financial statements, especially in the agriculture industry, a lot of times don't get a lot of attention because financial experts are not the types of people who are running a farm. And so we can come in and help you to analyze those things, look at, what you can do to strengthen your financial position and make sure that you're ready to transition on to the next step. Recently had, a banker call me, and they had a client who gifted all their stock in their corporation to their son. They thought, we don't need we don't need transition planning. We don't need people to help us. We just know that our son's getting everything, and we're just going to gift it to him and make it easy and be done. Well, what they didn't look at was the financial statements. When the son went to the banker, he said, there's more debt here than there is fair market value of assets. I can't loan you any money. The son had no idea until he got the corporation, and they called us almost in can we give this gift back? And that's never a fun position to be in. And so we really want people to reach out to their trusted advisors prior to making decisions like that. It's going to result in a much better plan for the future, a much better opportunity for the business to be successful, if you've had your advisors helping you along the process. Some of the other things that we look for in financial statements is if the owners have been fairly compensated. Sometimes people will take lesser of a salary because it's their business and they want to see their business succeed. Or they may be doing a lot of tasks that you wouldn't be able to hire one person to replace you, especially at the salary you've been taking. And so looking at, as the owner transitions out, what is it going to cost to replace that person? Are you going to be able to do it by just hiring one person? Or because you know the business so well, you've been able to take care of a lot of aspects of the business, and you committed a lot of extra time to the business that maybe someone else wouldn't. And so we find a lot of times that the owner can't be easily replaced by one person. And so what is that going to cost in order to have the right people involved in the future? So those are the, those are some of the financial versus the personal things that we like to help our clients work through. If we could go to the next slide. So because we're the accountants, of course, we have to talk about taxes and tax strategies. So we also always evaluate the entity structure. The tax laws are forever changing, but have changed a lot in the last few years. And so we want to make sure that your business is set up with the right entity structures to be able to transfer the most successfully to the next step. There was a time when it seemed like people were creating lots of entities to try to take advantage of the tax brackets, and especially for corporations. And so sometimes now we're actually trying to put some of these entities back together to simplify things. As you transfer out of a business, it's usually easier for someone else to come in when it's a little bit more simplified. Also, with the entity structures is looking at how the stock ownership is. And, for like an S corporation, you could have voting versus non-voting stock, so that you can separate the ownership of the entity from the management of the entity and who's making the decisions. And that can be important as you're looking at your transition. Is how important is it to you to own the business versus be a part of the management of the business? We also look at maximizing your tax brackets. So right now there's a flat corporate tax, and so that's a pretty easy one, but are you taking the appropriate amount of salaries out of the business to maximize your personal tax brackets and not leaving any dollars on the table there? And then utilizing retirement saving strategies. Some people are really great about taking money from the business and putting it in retirement. Other people have put everything that the business makes back into the business, and so they have to have money from the business to be able to retire or to transition on. And so there may be ways now to invest a lot of money into retirement if that's something you haven't done. And it's also a way to minimize taxes. The gifting and estate tax exemptions. So right now, the rules are very favorable for gifting and estate taxes. Each person has about an $11.5 million exemption. And so there's a lot that you can do that isn't going to cost you an estate tax or a gifting tax. Obviously, we don't know what the rules are going to be like in the future, and that's probably one of the biggest challenges that we face with our transition planning. Is the plan we come up with today could change, especially if the president changes, right? So just being flexible and making a plan that can be changed as needed is important. And gifting is always usually a big part of what we look at, because sometimes, especially if you're selling, transitioning to the next generation, selling stock is usually not the most tax advantageous thing to do. And so we look at ways that you can get money out of the business without having to actually sell the stock. That being said, taxes aren't always the number one thing to look at, right? We got to do what is right for the business and for the owners of the business. And sometimes that will result in a little bit of tax, but we will do our best always to try to minimize that. And then just other opportunities that we can think of as we evaluate each situation and where people could save taxes, things like having employment contracts with the owners that are transitioning out, to that the business will keep paying for their vehicles, or things like that can be deducted by the corporation and can potentially save taxes. Trust can be important as you look at who the next generation is going to be, and potentially even the next generation after that, if you want to set something aside for your grandchildren. So, or if you need to protect assets from a potential divorce. Those are things that are hard to talk about, but are always important in transition planning. So I think our job is to help have the difficult conversations and to help clients realize that they can transition out and the business can continue on successfully. So thank you all for your time.
Thanks, Dana. Having grown up on a ranch myself, I think the opening slide that Dana started with there really resonates with me, and it all begins with a conversation. And I think that there's a lot of folks in the ag world and in the entrepreneur world is that, they deal with succession planning by not talking about it, right? We'll just deal with it at a later date. And I think that's a big part of the driving focus that we want to have here today, is that all of this, to be properly executed, has to begin with a discussion. And so thanks for bringing that to us, Dana, and walking us through some of the angles that you have as a part of Wipfli. So the next one I want to turn to is a guy that I think probably looks and sounds as much like Montana as you could imagine. And if you haven't met Bill yet, you're about to. Bill Van Panigan is our expert attorney on the panel. Bill was raised in Missoula, graduated from Sentinel High School in 1974. He graduated from Stanford University. His tenure included a year of international studies at the Stanford University campus in Germany. He returned home to attend law school and graduated from the University of Montana in 1978. And then he went on and attended the graduate program in federal taxation at Boston University, where he graduated in 1981 with an LLM in federal taxation. In 1982, Bill joined the law firm of Zophelis, McDonald, and Lind in Missoula, and he is a shareholder in that firm, specializing in estate and succession planning, estate and gift taxation, commercial law, and business transactions. His clients include family and closely held businesses in a wide array of industries, including technology, manufacturing, construction, real estate development, and professional physician groups. His expertise includes business restructuring, preparation of ownership and asset purchase agreements, management agreements, and business continuity agreements. Bill, it's great to have you. We look forward to seeing some of the perspectives that you bring.
Yeah, thank you very much, Todd. I appreciate it. I'd also like to take a moment to thank the Montana Chamber for sponsoring this event and this outstanding group of panelists and the valuable contributions that they are making here this afternoon, and especially to all of you who have taken time out of your busy schedules to join us today, and hopefully we'll come away from this panel discussion with some value. My law firm is based out of Missoula, Montana, and as Todd mentioned, we are involved in business transactions. We represent clients throughout the state of Montana and in the region. My law firm is a member of the Primaris International Society of Law Firms. So we have sister relationships with other law firms throughout the country, which allows us to do business in other parts of the country that ordinarily would not be available. My presentation today is focused mostly on some of the legal issues that business owners face in the estate and succession planning process, which is a small piece of the big picture, but I think nevertheless an important piece. So I hope that the information that I deliver today is helpful to everyone. By way of introduction, I think as Vu mentioned, and I think he did a really good job in providing everyone with a definition of succession planning. In my practice, what I tell my clients is that creating and preserving value for your ownership interest is fundamental to a successful succession plan. And I also tell people that the business may be successful, but it also could fail you in unexpected ways. In succession planning, we're not talking about business success. We're talking about an owner-based definition of success, not one that measures success based upon how the business performs, but the benefits that the owner receives when the owner is ready to leave. Because in the end, what every owner wants is the ability to leave the business under the most favorable conditions. And as some of the other panelists have mentioned this afternoon, there is one universal truth in business life, and that is that at some point, at some date in the future, you will leave your business. And you can leave it successfully, but to do that, it is essential to create a successful exit plan and have the time to implement that plan and then stick to it. Throughout the course of my career, which in the estate and succession planning arena has now spanned over 35 years, I've had situations where clients have come to me, one just several years ago, a husband and wife firm that had built a very successful, profitable statewide business, woke up one morning and said, you know, we're just tired. We've done this now for over 30 years and we're ready to move on. You know, we talked about that, and they had no children that were interested in the business. They had no employees or co-owners that were capable of stepping up and taking it over and moving it into the next, chapter of its financial future. And after a lot of analysis and market review, this particular business just didn't really have a market for a third-party purchaser. And these people had just decided that they were ready to exit. They were tired, they didn't want to continue, and they were ready to get out. And I think that this story, which is not uncommon, illustrates a very important point, and that's that a business can be very profitable for a long period of time and yet have little value above and beyond the liquidation value or a fire sale value without proper planning. So what happens? You have hardworking, knowledgeable, successful people. How did they find themselves in this dilemma? Well, they had no succession plan, and they never took the time to create a market for their ownership or an exit for their business. You know, it's ironic because for years they devoted themselves to the day-to-day management of this business. They personally handled hundreds of details. They spent substantial overtime with clients and customers, dealing with crises, putting out fires like we all do. But isn't that the problem that most business owners face? We're just too busy during the course of the day and the daily crunch that we never take time to plan for the most important owner-based objective, and that's leaving the business under the most favorable conditions. And so what happens? The business disappears, employees lose their jobs, the owners sell for cash from the sale of tangible assets, and they receive much less in value than what they built up as a going concern over the years, all of which could have been avoided with proper succession planning. Could I have the next slide, please? Next one after that one, please. Thank you. So Todd and Dana have both talked about how important it is to start the conversation. And it's important to start that conversation early on in the process and leave adequate time within which to complete a successful plan. So what I put together for you today is a list of essential questions that I think are important for business owners to consider before at the time that they start the succession planning process. And here are a few. Have you identified the individuals to whom you intend to transfer your ownership interest? Is it children? Is it employees? Are there co-owners in place? Or is this a situation where a third-party purchaser is the most viable option? What income and estate tax strategies are available with each of these potential scenarios? And I think it's important that any succession plan be synced with the owner's estate plan and personal financial objectives. As Vu mentioned, do you know the value of the business? Do you value that business annually? And if so, what methodology do you utilize? Has the business been appraised? Have you considered ways to increase the value of your ownership interest through enhancing the most valuable assets you have, namely your employees? What documentation is required to implement an effective transition plan? And I'm going to get into that in a little bit more detail in just a moment. And probably most importantly, have you identified a departure date? Do you know when you want to leave? And if so, do you know the income and resources that you have at your disposal to provide for the financial security of you and your family? Next slide, please. So one of the critical roles that the lawyer plays in this process is what I refer to as a legal review or a legal audit. And we always ask the question, why is a legal review or a legal audit important in succession planning? Well, probably the main reason is that the legal review is a precursor to a more extensive due diligence review that is going to be undertaken by a third-party buyer. And what the legal review does is it provides the selling owner with an opportunity to troubleshoot problems before they occur. And so we have to ask the question, what is a potential buyer looking at during the course of due diligence? Well, there are a myriad of issues that are going to arise at the time that you sit down at the table to negotiate a deal with a third-party purchaser. Litigation exposure and risk. Vu mentioned this as part of his analysis in terms of de-risking the business. Environmental exposure. Are there environmental issues that are lingering that haven't been addressed? Unsigned corporate documents or incomplete corporate records. Missing share certificates, gaps in annual minutes, employment agreements, and non-competition arrangements. Are all these documents in place for a potential purchaser? And in my experience, the legal review is not only a precursor to the due diligence process, but it also results in a savings of thousands of dollars to the client. Because once these issues have been addressed and addressed satisfactorily, they don't need to be addressed again during the due diligence process, or if so, just updated. And it places the seller in a much stronger negotiating position with the buyer. I had a situation a couple of years ago where I represented an internet-based company that wanted to sell, and this company had not consulted with FCC licensing counsel for a number of years. They'd just gone on and done the internal filings and compliance issues in-house on their own. And when we got into the due diligence process, we discovered that there were compliance issues that had not been adhered to and regulations that potentially could have been violated. And that put the brakes on the negotiation, because at that point, the buyer insisted on representations and warranties and indemnification provisions in those documents that were unrealistic. So it's real important that these areas be reviewed in advance and that they be, as Vu mentioned, de-risked going into a negotiation with a third-party purchaser. And as I mentioned, one of the key provisions in negotiating a sale to a third-party purchaser, whether it's a consolidation, a merger, an outright disposition of ownership interests, are the provisions in that buy-sell agreement that deal with the seller's indemnification responsibilities and the warranties and representations that the seller is going to have to make to the buyer in order to get the deal closed. And if the seller has done his or her homework and has addressed these issues, that negotiation is going to go much smoother. Next slide, please. So I thought it would be important to talk for a moment just about one of the key documents that the selling business owner should consider early on in the process, and that's the business continuity agreement. And I'd even go so far as to say that the business continuity agreement is the most important agreement that the business owner may ever sign. I refer to the business continuity agreement oftentimes as the damage control instrument. Why is that the case? Well, the business continuity agreement accomplishes a myriad of important objectives. It controls the transfer of ownership upon the occurrence of certain events such as death, disability, retirement. If the business owner wants to bring employees into the business as equity participants for incentive compensation purposes, it's important to tie those equity interests into the continued employment of those employees to ensure the continuity and stability of the business going forward. And then divorce, and then also business disputes. The business continuity agreement is also important because it establishes the value of the business for buyout purposes, and more significantly, it forces the owners to sit down and think through that valuation process, how they want to structure it, and then meet with their advisors to arrive at a value. And there are a myriad of different ways to do this. Will you set a value for the business each year at your annual meeting? Will you draft into the document a valuation methodology? Or will you defer to a third-party business valuation specialist if and when the need for evaluation arises? These are all issues that need to be well thought out, considered, and discussed. The business continuity agreement also deals with restrictions on the transfer of ownership and defines who can sell and under what circumstances. That's very important, especially in a closely held business. We've seen situations where employees or minority shareholders have been brought into a business with small percentages. And we want to maintain for the majority owners that closely held structure of the entity. And in order to do that, it's important to restrict the circumstances under which a minority shareholder or a minority membership interest holder could transfer that interest to an unwanted third party. The agreement also provides the terms for payment of the purchase price, including the interest rate, the length of the buyout term, and most significantly, the security, so that if there is a buyout or if there is a sale, the collateral position and how that's structured becomes very critical to the selling shareholder, especially in the event of a default. Because in the event of a default, those collateral documents are the owner's insurance policy to either get the business back or have another remedy in the event that the buyer on an installment contract can't or won't pay. And I think finally, one of the most important features of the business continuity agreement is that it really forces the owners of the business to sit down and communicate with each other to resolve issues. We see this so often where different owners have different perceptions about the future of the business. They have different perceptions about their individual importance to the business. They have different perceptions about their roles. And then for whatever reason, they just stop communicating. With the business continuity agreement, there's an opportunity. And the opportunity is to sit down with the other owners and the key employees to discuss the future and to communicate about these issues and get them resolved. And more often than not, that process results in a healthier, more stable business with everyone on the same page moving forward to an ultimate exit for the majority owner. Like I say, these legal considerations are an important piece to the puzzle, but they're only one piece. There are, a myriad of other considerations that need to be assumed in this process, as you've heard today. But I hope that these points that I've made today are helpful to you in getting a better understanding of the documentation and the negotiating process, which, has to occur at some point. So thank you again for allowing me to participate today, and I'll turn it back to Todd.
Thanks, Bill. And Bill highlighted a big reason why the Montana Chamber is hosting this is in the very beginning, he noted kind of a worst case scenario where business owners were left with not many options. And the ultimate result was, a loss to the business owner and to the state of Montana and the employees that work there. And those are the interests that we're trying to avoid happening with this succession planning sort of webinars, try to prevent that worst case scenario for those business owners. So we turn next to a Montana success story in D.A. Davidson. And we've got Ray Round with us today to represent D.A. Davidson. Ray is a certified financial planner and is also a certified wealth strategist, leverages close to 3 decades of financial knowledge and expertise. In 1992, began his career serving as an investment executive with the major New York Stock Exchange firm in Spokane, prior to joining D.A. Davidson in 1995. Over the years, Ray has served on D.A. Davidson companies and D.A. Davidson Investment Advisors Board of Directors and on the D.A. Davidson's Managed Assets Investment Committee. He's been a member of D.A. Davidson's Chairman's Council since 2002. Ray earned his Bachelor of Business Administration and Finance from Gonzaga, fellow alum with James Thompson, and is an active supporter of both his alma mater and the University of Montana. So we have another Grizz on our call here today. So Ray, thanks for joining us, and please walk us through some of your perspectives from your standpoint.
Well, thank you, Todd. That was an awful nice introduction. So I will skip forward immediately. Also trying to be cognizant of the time here. I'm going to give a quick overview of our firm and my team within D.A. Davidson. Many of you may be familiar with D.A. Davidson, as the firm was founded in 1935 in Great Falls, Montana. We're excited to say we remain employee-owned today. As a financial advisor, I'm one of more than 370 financial professionals working for the wealth management division from 70 locations across the Pacific Northwest, 11 of which are here in Montana. In addition to the wealth management divisions, D.A. Davidson companies also include a trust company, aptly named D.A. Davidson Trust Company, an in-house investment advisor, which is Davidson Investment Advisors, a fixed income management division, and a full-service equity capital markets platform. I'll just say our capabilities are broad, and we have the depth of knowledge and resources across the firm to assist business owners in transition. Next slide, please. Within D.A. Davidson Wealth Management, I'm the senior member of a team, the Round Carlino Investment Planning Group. We put together this group because we believe a diverse skill set across our team enable us to provide a more comprehensive experience for our clients. My team includes my partner, Sydney Carlino, who is also a certified financial planner and certified wealth strategist, and 2 client associates, Marla Cassidy, who is a registered client associate and a registered paraplanner. And the newest member of our team is Megan Ingersoll, who is in the process of becoming a registered client associate. We are dedicated as a team to helping our clients manage wealth through all of life's transitions and really allowing you to spend more time with family and friends and doing the things that you care about most, which is really why we're here today. Next slide, please. So business transitions are one of the most challenging and rewarding opportunities we as financial advisors have to make a difference in our clients' lives. As this panel has shared, there are a wide variety of needs and considerations when it comes to transitioning your business. Our role as financial advisors is to help you design and implement a comprehensive personal financial plan and wealth management plan, and to coordinate with these other trusted advisors to guide you through this process. We really want to help create the picture, before you pull the trigger. And what I want you to really think about is, and the message that I want you to receive is, you want to get your financial advisor involved in the process early in the process, and you'll understand as I continue through. I'll touch upon it more in a bit. An experienced financial, next slide, please. Really, there are 4 steps that an experienced financial professional should be able to guide you through the preparatory process. Much of it was touched upon earlier. The fact that I'm going 5th, much of it is overlap. I'm going to touch on a brief comment on vision. I know Vu touched upon it earlier, but it's seemingly is an obvious first step to create your vision, but fewer than half of business owners have a transition plan in place. And there are often gaps between your vision and the infrastructure in place that is needed to execute that vision. I think that's what the prior speakers were talking about. What I want to just touch upon is it's so important to have clarity on what you're transitioning to. As Vu said, what will you do with your time? Are you going from, an 80-hour or more a work week at the business, and now that time will be at home? As an example, my most recent business transition was end of last year, early this year, where my clients were transitioning the business to their son. And Dad was going to stay employed by the company for a couple of years, really to help transition the workload to the son. He's also under full retirement age, so he could collect a salary for a couple of more years. But the real reason was slowly to get Mom comfortable with having Dad around the house full time. And then after 3 months, COVID-19 shut down the economy, and the business's revenues dropped in half. The workload dropped in half, and the son had to start cutting some expenses. We didn't plan for a viral pandemic, but fortunately the owners had created a vision, and we created a plan prior to the transition with multiple what-if scenarios. So we simply pivoted to plan B, and happy to report Dad is now transitioning back to full-time spouse from the golf course rather than the office. The second step in the transition phase is building your trusted team of professionals. I'm not going to spend any time on this whatsoever, as you've heard from many of them here today, except to say that it's extremely important to have the team around you with a depth of knowledge and experience, again, early in the process. So most of the rest of my presentation is really on steps 3 and 4, which is defining your financial goals and objectives for post-transition, and specifically your income expectations. So this is not only an obvious step, but it's overlooked in the pre-planning before sales stage. You know, this ranges from budget and cash flow projections, illustrating various transition sales strategies, to developing your financial and estate plans. How much will you need to maintain your lifestyle as you have envisioned? Are your goals and objectives realistic? And are your income expectations reasonable? Most clients underestimate their income needs in retirement, but more importantly, they overestimate the amount of income their investable assets are able to produce. This is almost always the most enlightening process when I'm sitting down with business owners. You see, it's critical that you're able to see what your vision and plan will look like and how it will impact your lifestyle, your family, and your philanthropic goals before moving forward with a transition or sale. And then finally is creating thoughtful wealth transfer and estate planning strategies. This is to ensure your vision endures for future generations and for your valued charities. Considerations like personal reps and trustees. Have you thought, or do you have a trusted heir or individual to act as your personal rep or successor trustee? And as importantly, do they want to be in this role? Or might there be a benefit in naming a corporate trustee, which would remove conflict of interest, or the most important thing, confrontation amongst your beneficiaries? Will a business sale cause you and your family to be affected by things like the sunset provision on estates? This is a provision that goes into effect January 1st, 2026, where the exemption amount on the estate goes from $11.5 million per individual to $5 million per individual. Does the sale have an effect on your personal overall estate, or will it impact your goals and objectives? Is one of your goals to maximize wealth transfer to your heirs? If so, is there a need for a risk management plan to protect your existing wealth? Or is there a need for tools and solutions to replace wealth lost to estate taxes? And finally, is there charitable intent? If so, how will you develop your charitable aspirations? And how will they be funded? Developing thoughtful financial and estate plans aligned with your vision will answer many of these questions. Next slide, please. So as important as discovering your vision is to your pre-transition phase, the process of preparing to execute your plan is equally important in the transition process. For most business owners, we've heard it from all of the panel members, the business is part and parcel of who you are and where you derive your sense of purpose. You built the business yourself. You've had control over every aspect of it for years. You know it inside and out, and it's what sustains your lifestyle and family. These elements of business control and income generation will be separated post-transition. And it's important to mentally prepare for this change. We have guided many business owners through the process of ceding control. And this is important. You have to shift to an investor's mindset rather than that of an owner. And I'll tell you from experience, it's easier said than done. Success as an investor requires an incredible amount of trust in others. You must be comfortable with your advisor, their philosophies, understanding of markets and portfolio construction, risk management. And it's really the advisor's job to coach you through all of this so that you can maintain your income and ultimately achieve your goals and objectives. Moving to an investor's mindset is critical in being able to execute the financial and investment plans. It's not uncommon for business owners to struggle to pull the trigger, so to speak, when it comes to executing their investment strategy, because they don't have control once they invest the money. And the time spent uninvested can have significant long-term impacts on your financial plan. So it's our job to arm you with the information and understanding you need to make wise and prudent investment decisions in a time frame that'll keep you on track to meet your goals and objectives, which is why it's so important to involve your advisor so that you can create these pictures ahead of time so you know where you're going. Finally, the role of an advisor is to have ongoing reviews and check-ins so that we can adapt and refine your plan as your needs and goals change over time. And finally, to support you in coordinating the execution of your wealth transfer strategy to your heirs, your charities, or whatever your intentions. So with that, I would thank you for your time and let you know that any of D.A. Davidson's financial professionals around our state would welcome the opportunity to provide you with additional information, guidance, and advice regarding the business transition process. And with that, I'll turn it back to Todd.
Thanks, Ray, and thank you for bringing forward an important part that I think is as important as the legal and the financial preparation, and that's the emotional and mental preparation for transitioning out of a business. Making sure that we spend enough time thinking about this change of roles as you prepare for exiting a business and succeeding control of that sort of business. So we're going to turn next to, I think, a real exciting piece of Montana and an exciting company. Don McGee is the CEO of Good Works Evergreen. In 2006, she founded Good Works Ventures. It's an impact investment fund focused on Montana startups and mid-sized businesses. And it started because 2 years ago, she noticed that retiring business owners were struggling to sell or transition their businesses, causing jobs to disappear. Sometimes that occurred almost overnight. And Dawn and her team launched Good Works Evergreen to purchase and operate those businesses into the future, which is good for owners and good for Montana. In addition to having managed a family office, she has raised and been part of 3 social impact investment funds over the last 25 years. Dawn?
Thanks, Todd, and thanks everybody for sticking with us this late in the afternoon. I'll try to keep my remarks fairly brief so we can get on with the rest of everybody's day. We're part of that mythical unicorn species known as a buyer, so I just kind of wanted to talk about what that looks like from our perspective and why we're in the business that we are. Next slide, please. So about 15 years ago, I came to Montana and have been working in the sort of economic development as part of a family office here. And what we've really focused on is creating jobs and robust and well-paying jobs. And 15 years ago, we started working with the crew across Montana, investing in small businesses and startups primarily. And we did that very successfully, and I would say that, you know, because of the group of people who invested and took early risks where nobody was willing to, we stopped exporting our biggest brain trust, which was all of our kids that were graduating from the university, that most of them had left the state because they wanted to find great opportunity. But we've created a huge amount of startup culture, tech companies, biotech companies, and the like. So we now have $1 billion tech economy in the state. And if you want to have a good paying job in the state of Montana, you don't have to leave to go find one. Then about, I would say 3 years ago, I was reading in the newspaper that a gentleman had died who was running a tarp manufacturing business. He manufactured tarps for trucks and boats, high-end tarps. And 10 people in the community of Stevensville lost their jobs overnight because that gentleman hadn't done what every other panelist has been asking people to do, which is do your estate planning, please, before it's on your doorstep. And so that business closed down, 10 jobs went away. The repercussions of 10 jobs going away in a small community like Stevensville has repercussions at the grocery store and at the local brewery and everywhere else. And so we kind of took a look across the state of Montana and said, wow, this is going to happen in a lot of places, like not just Stevensville, but everywhere. And, you know, much to the surprise of many people in Montana, we have a lot of really small businesses, manufacturing and otherwise, and nooks and crannies stuffed all across the state. And so we decided that we wanted to start acquiring these businesses before they failed to transition, and that we would not only retain the jobs, but make them more robust. Next slide, please. I'm just going to go ahead and skip that one for now. We can go to the next slide. So we set ourselves up as a perpetual operating company, and we hire the next generation leadership that works for us. And what that means, in contrast to a lot of investors, is we're not private equity. We don't have any intention of selling these companies. We intend to build a broad bucket of businesses that will act as a holding company. Eventually, we'd love to get ownership in the hands of people all across the state of Montana who are interested in owning a piece of their heritage and that can pay a reasonable dividend. And so we're really focused on not just jobs, but good jobs. In all of the companies we've bought so far, we have raised the prevailing wage, and we have provided a full suite of benefits package, including 401ks and health insurance to all of our 60 plus employees. Next slide, please. So how are we doing this? We have a team of people well steeped in operating companies, fortunately, and diverse companies that's the case. Everybody on my team has run a company, at least one, if not more, multiple companies, and we're very much hands-on operators. While we hire a general manager to operate the business in question that we acquire, we go in and do kind of a soup to nuts audit of the business and sort of bring new age practices, including like SEO optimization and other things that may not have been applied to conventional businesses in our state for a long time. We do reinvest in capital, we reinvest in sort of upgrading the business processes and procedures, and we make sure that our businesses are gonna be successful into the future. Next slide, please. So the businesses we buy, we bought businesses, we love long operating history. We love seeing businesses that have already gone through multiple recessions. We want there to be 5 or more employees because we're really focused on creating jobs. We don't want to buy turnaround businesses. We want the businesses to be profitable as they are and allow us to continue to sort of maximize that out, and you know that they have to have net income earnings. I would say sometimes it's better to be lucky than good, because our first businesses happen to be largely in the wood products industry, which in the time of COVID was really important. We were deemed essential operators, and people stayed at home and decided to fix up their houses and buy more things than they ever had from our businesses before. So we've been in a lucky sweet spot on the sort of lumber and home center space. We've done due diligence, and I would say more than 65 businesses. We are actively buying businesses. We anticipate buying at least one a quarter, if not more, going forward. And if you have a business that looks like a sweet spot, we would love to talk to you. Our aim is to always leave you better than we found you, meaning if we're not the right buyer for you or we can't help you, we try to offer everything we can to help situate yourself so that you can be poised for a sale. So I'd encourage any of you who are thinking of selling your business to reach out, and I look forward to talking with you, and I'll keep my presentation at that today.
Thanks, Dawn. Great example of the various options that are available to business owners in Montana with what Dawn is doing at GoodWorks. And so thank you for doing that. I want to thank everyone again for joining us. There's going to be a quick little survey that will pop up when you exit this video conference. It's a survey just to kind of give us some feedback on how we can make improvements and continue to strive for excellence as we provide these sort of webinars. Let me conclude too by saying that this is an important piece, I think, for all of us to be thinking about, and for the Montana Chamber to have this role to bring experts together for business owners and for the health of Montana going forward. We know that the average recession lasts about 10 years. And that sort of daunting piece in front of us tells us that we're probably in for a little bit of a long haul. But the good news is, right, there's options, and there is investment money out there looking for homes. And so if this is something that you're contemplating, we would encourage you to visit with your trusted advisors, or please reach out to any of the folks that are on this panel to initiate that conversation and begin that discussion about how best to transition your business out. So thanks again for everyone.
Todd, I hate to
Yes.
interrupt. This is Kim, also from the Chamber, and we do have a question that was typed into the chat box. Just one though, so it could be brief. So I think it doesn't specify who it's directed to, so I'll read the question and whoever wants to take the first crack at it sure can. So the question is, what role does personal finance planning play in the process? What kinds of multiples of EBITDA can I expect, and what affects the determination of the multiple? How does ESOP work, and what are its advantages and disadvantages? So it's kind of a three-part question here.
James, do you want to try to take a first crack at that, since you're kind of our ringleader here on our panelists, and you might be able to direct somebody else for a piece to fill in some additional blanks?
Yeah, just from a multiple standpoint, and then maybe Ray Round can weigh in on the personal finance side. Multiples, size has a premium. So the bigger the business you have, the higher the multiple that can get paid on an exit. So that's a general guide. And I would say 5 to 7 times EBITDA is probably a good range to think about. If it's growing rapidly and has high gross margins, you're going to be on the higher end. You might get up to 8 or 9. If you're lower growth and a little more risk of the equation, you might be in the 4 to 5. I'm sure Dawn would weigh in, and she's a buyer now, so she'll tell you it's 2 or 3.
One.
One. I represent the sellers. I don't represent buyers. Ray, on personal finance.
Could I have that question again, just so I make sure I'm understanding?
Sure. The question is, let's see here. What role does personal financial planning play in the process?
Well, it's obviously extremely important in the process, and my message to the folks is it needs to be done pre-transition. what we need to do is we need to create the picture so that you're not going to have all the answers and things change, but we need to create a picture and see if you're comfortable with that picture. Specifically, I often get the question, well, how much money can I expect my assets to produce in retirement? And, unfortunately, as James mentioned, it's dependent upon asset allocation. We all know the troubled bond market we have now, where we can go out 5 years on a CD and get 0.5% maybe. The 10-year treasury is below 1%. So bonds are not creating the type of income. I'll give you a range. We typically tell people that you can expect 40 to 45,000 per million in net investable assets from a reasonably allocated portfolio. Like I said, that's a rule of thumb. I certainly would advise you to go to a trusted advisor and sit down and determine, where you fall on the risk curve, how much you can invest in equities and accept the volatility, because that's determinative of how much income, your assets are going to produce. And that is a very big question. I mean, I could go off on estate planning as well, and the idea of, goals of maximizing wealth transfer to children or passing away with your last nickel in your pocket. And trust me, we have both ends of that spectrum.
Yeah, just a comment on the ESOP. I'm on the board of a large steel distributor out of Denver, and it's an ESOP. And I would suggest, if you're thinking about an ESOP, you should talk to your lawyer and understand the trade-offs.
I would also comment that, I'm working with a client right now on an ESOP model, and it's expensive to do, but if I think the true special sauce is culture and a willingness on the buyer's side to do that. There is legislation right now that is currently sitting in the Senate to actually create a temporary ESOP grant, and it is it's called the Temporary Federal ESOP Grant Program Act of 2020, and it's suggesting, if it passes, to the federal government will grant each employee $20,000 to buy into the ESOP for a transition, which is a big deal. 200 employees, that's $4 million right there. So we've been monitoring it pretty carefully to see where there's opportunities on that side of it. But it's not an inexpensive way to transition, but and it's a good way, especially if you're looking to keep businesses in certain communities, in certain places where where it may not have the multiples it could get potentially otherwise. So there's a lot of factors in there.
Great. Thanks, Phil. I apologize. I kind of started to breeze past the Q&A part of this webinar. And Kimberly, feel free to jump in if we have any other questions that were typed into the chat box. For anyone else that might have a question, if you're comfortable in just unmuting yourself and asking the question, now would be a good time to do that, or type that question into the chat box and we'll do our best to get it answered.
I'll throw something else out, which we haven't raised, but the importance of thinking about life insurance as a vehicle to bridge gaps financially for estate planning purposes, whether it's whole life, term life, or premium finance. I think that's worthy to raise, to think about it as part of the other tool sets that we've been talking about thus far.
Todd, there are no more questions in the chat box right now.
Thanks, Kimberly. Any last call for any final questions that you might have today? Well, great. Well, thank you again, everyone, for joining us. I want to thank the panelists for volunteering their time to participate in this. And I want to encourage anyone that, you know, if this is something that is starting to be a part of your thought process, that if you don't have someone that is already one of your trusted advisors in any of the fields that we covered here today, please feel free to contact these folks directly. We are going to share this slide deck on our website so that if you want to go back and gather up any of the additional information that was provided in any of the slides or the contact information for those folks, we'll make that available here in the, probably by this time tomorrow as we get that uploaded onto the website. So thanks again to all the panelists for the expertise and your insight into this. And thank you everyone for joining us.
Thanks, Todd.
Thank you.
Thank you, Todd. Thank you, Kimberly.
Thank you.
Thanks, everybody.